Welcome. Dive into the world of call options, a fascinating financial instrument. A call option is a contract offering the buyer the right, not the obligation, to purchase a stock, bond, commodity, or another asset at a predetermined price within a certain time frame. Bought a call option? You're essentially wagering that the asset's price will climb. If it does, you're in luck. Exercise the option, buy the asset at the lower strike price, then sell at the higher market price for a neat profit. A call option has three key components: strike price, the buy rate if the option is exercised; expiration date, the deadline to exercise the option; and premium, the fee paid by the buyer to the seller for the option. Call options aren't just for speculation. They can be sold for income, used in tax management, or combined in spread or combination strategies. However, they are not risk-free. If the option expires worthless, you could lose the entire premium. So manage your risk, set stop-loss orders, and avoid over-leveraging. Remember, a call option is your right to buy an asset at a set price within a set period. It's a tool for speculation, income, or tax management, but it does come with risks. So manage wisely and avoid over-leveraging. Thanks for tuning in. If you found this enlightening, don't forget to like, share, and subscribe. For your convenience, we've provided subtitles in yellow text. Until next time.